we're looking for deals that can provide, consistent cash flow throughout the hold of 7 to 12% average. And then there's usually almost always a value add play of sorts that we're going to implement at the asset, grow net operating income, improve performance. For example, in the mobile home park and self-storage space, one of our operating partners recently invested in, they have a team of 8 full-time cold callers, Corey. All they do is call mobile home park and self-storage owners, and they've been doing that for over 10 years. So they have a Rolodex of, it's like 93% of the opportunities that they buy, they're going direct to the seller, and there's no realtor or broker involved, and they're usually buying mismanaged properties where the rents haven't been raised in a decade, and some of them they're managing with a notebook, and they don't even have software. And so that's the kind of stuff we like to see, where you can come in and improve performance and implement, institutional management standards and really grow NOI.
Yeah, I read an article a couple of weeks back about sort of the high-end mobile home business, like booming. It seems to be booming because of it. And they alluded to what you just alluded to about maybe mismanagement is unfair, but just old school management, like you say, with the notebook and no software and no one enhancing things and not understanding the opportunity they have in front of them with respect to the land and things like that. Pickleball courts and all these things that they're developing on the land. It seems extremely opportunistic. Obviously, I don't see all that much. I'm sitting here in the city, so I wouldn't be investing in all that stuff. But I've heard that often.
Yeah, we love those sectors. We've been in mobile home space since 2011 or 12 now, Corey, investing. Oh, wow. Back then, going in cap rate 10%,
right.
Preferred returns 10%, you hit them year one. That doesn't happen anymore. The space has become a lot more competitive.
Yeah.
And so, going in cap rates can range anywhere from 5 to 8%, depending on location and quality.
Hello, everybody. Welcome again to the Zelnik Exchange. I am your host, Cory Zelnik. Today, I have the privilege of speaking with Mark Khuri. Yes, pronounced like Steph Curry. Mark Khuri from SMK Capital Management out of Bend, Oregon. He is a fund manager who left the world of finance to get in the real estate business about 15 or so years ago. He's going to walk us through that process. SMK is a company that he has founded with his dad, Dr. Khuri. And, we're excited to hear this story. This is a little bit different for us. We haven't done fund managers before. You are our first. And I really am looking forward to this conversation. Mark Khuri, originally from Albany, New York, now in Bend, Oregon. Mark, welcome to the show.
Hey, yeah. Thanks, Corey, for having me. Appreciate it.
It's my pleasure. So, the bio says corporate finance, and I decided to do real estate and create this fund, SMK. But, tell me about the journey. Tell me about, Albany, New York, and what gets you across the country, and anything that you find interesting. We want to learn more about you.
Sure. Yeah. Corporate finance was the W-2 for about 8 years. Spreadsheets, analysis, budget planning, internal auditing, you name it, a lot of financial analysis. But I started investing in real estate, Corey, on the side as well.
Okay.
This is 2005. So before the spike up and the crash, of course, in 08, 09. And through that time period, up till I'd say 2010, what we were doing, my family and I were pooling our own capital together. We were buying distressed properties, all cash from the bank, right? It was really very difficult to get financing through the recession. And so we were buying boarded up houses that had been sitting on the bank's books for a year or two.
I was going to say, so just strictly houses or anything?
About 12 units or less was kind of our target.
Okay.
And predominantly in our backyards at the time. So my father and my parents were going back and forth to Florida, and I was in California. And so we were buying in California and Florida.
All right. Cool.
And we did that for, 5 years.
Mm-hmm.
Built a small portfolio, obviously through the recession. And essentially, I was hooked, right? I was in love and fell in love with real estate investing, and decided to leave the W-2 and partner with my father. He's a retired orthopedic surgeon by trade, and his medical practice was slowing down at the time. So we decided to partner up and kind of go all in on what we'd already been doing as a family and just start raising capital and creating funds with investors outside the family. So that's kind of how we got started. Feel free to poke and ask more questions, but that was
no, of course. But so when you start this fund, is it initially, friends and family, the folks around you that are jealous you're making all this money and I want to put some in? Does it start that way? Because I'm not a fund guy. My expertise is retail leasing. That's what I do. It's what I've been doing for many, many years. But I'm an LP, and most of the time it's retail related, because at least I know what I'm looking at, kind of thing. I did some passive stuff on some resi, made some money, lost some money, not for me. I want to know what I'm doing. So did you go out to the people that you know first? Was that the start of how this was created?
Yeah, exactly. So we basically went out to friends, family, some colleagues, invited them all over to our house in Albany, New York. Had a PowerPoint presentation, food, drinks, right? The whole shebang. Showing them our portfolio that we had built as a family so far, and then just kind of expanding on that was the initial plan 15 years ago. And so that was how we got our start. And, it was really just trust, right? People that trusted us were investing with us. And so those are the humble beginnings for sure, Corey.
Well, that's great. And then I know that, you talk, obviously I did some homework on you, to have some understanding. And while we're all in the business to make money and make as much money as possible, there are riskier things you can invest in. There are less riskier things, obviously. But you talk about, keep being as risk averse as possible. You talk about storage units. You talk about a variety of things that you invest in beyond just the homes. Could we talk to me about that?
Yeah, so maybe I'll give a little bit of a kind of a transition, how we got
Please.
started at the firm. Again, our expertise at the time was as a sponsor and operating partner in single family, small multifamily. So for the next 7 years, we were essentially an operating partner in that space. We acquired, rehabbed, operated, a 60 property portfolio across a few different states.
60 or 16?
Yeah.
Oh, nice,
60.
nice. You acquire a 60 property portfolio.
Yeah, we built that out. Each property we renovated, heavily renovated. So they're all heavy value add. We're basically buying pennies on the dollar properties in different markets, taking advantage of what the market was giving us. Most of them were either sold shortly thereafter or held for rental. And so we built that portfolio and that process of our business up for 7 years. But at the same time, Corey, when I left the finance gig, I had a kind of a retirement account sitting idle there. And when you become self-employed, there's, not as many advantages with company matching, et cetera.
Of course.
So I transitioned some of those funds into a self-directed IRA.
Okay.
This is in 2010, 11-ish. And I started looking for places where I could invest some of my own personal retirement funds outside the stock market. I was very interested in some of the asset classes in real estate that had actually done fairly well through the recession. There wasn't a lot, if you can imagine, but so we started investing in some mobile home parks and some self-storage and some apartments and a few other asset classes, really looking for diversification. We were investing as LPs with sponsors that had been referred to us from other investors that had already done well with them.
Okay.
A lot of word of mouth. And over the next 5 years, my family and I made about 25 different LP investments in
Wow, that's a lot.
10 different commercial real estate sectors. Some of the ones I mentioned. We also invested in senior housing, student housing,
Sure.
some oil wells down in Texas, right? Just very diversified. But by the end of that period, right around 2016, 2017, we had built a nice portfolio with our investors. We also had built a nice investment portfolio as LPs in other operators' deals, and we could compare and contrast risk and reward across those different strategies. And the market was getting tougher for single family and small multifamily. A lot more competitive deals out there. You're basically chasing lower margin with a lot more work. And so we kind of knew the writing was on the wall, and that era was essentially not going to be as attractive going forward. And we started pivoting slowly to what we do today. And so by 2017, we started offering some of our operating partners opportunities to our investors. We create a partnership, we negotiate more favorable terms, and then we allow our investors to diversify and kind of essentially take the same business plan we were doing personally and those relationships we built. And so that's what we do today. We work with a number of operating partners that we think are some of the best in their business, specialists in one thing, rather than us trying to become experts in each of these asset classes. We take more of a private equity, boutique investment management fund approach.
Right. So you're out there, if I'm understanding correctly, you've done some of the homework on these operating partners, right? On these operators, if you will, and you're telling the people in your fund, this is how we're going to direct the money. I just want to make sure I'm understanding it correctly. And are you setting it up as mobile home fund 1, self-storage fund 17? Is it that sort of the approach?
Yeah. So in context, yes, but I'll be more specific on how we do it. So we have underwritten, vetted, analyzed, over 150 operating partners over the years, and a lot more that were kind of a quick no.
Okay.
So we're getting about 2 to 3 deals a day across our desk that we're analyzing to determine if they're worth investment, if they meet our investment criteria. When we find one that does, Corey, we will essentially, after underwriting, vetting, and analyzing and having many chats with our operating partner, once we have a green light to go, we'll send out a notification to our investor group, hey, we have a new deal. If it's a single asset deal, Corey, we'll mention, hey, we're investing in this property at 123 Main Street.
Right.
Here are the terms, the waterfall, the projected returns, why we like it, et cetera, et cetera. And then we'll create an SPV, special purpose vehicle, just for that investment.
And and are you going in as an LP in that situation, and you're bringing them along for that sort of for the ride?
Sometimes it honestly depends. Sometimes we'll co-GP, sometimes we JV, sometimes it's LP. It depends on the deal, the operating partner, the amount of capital needed, the amount of capital we're bringing. And so the structure is case by case.
All right.
And sometimes we'll create a fund where we'll combine several properties, several assets over a period of 3 to 6 months into one investment vehicle for investors. We typically do that once a year, where we'll take the 5, 6, 7 best investments that we found for that year and put them all together into a diversified fund so that our investors can spread their capital across sponsors, geographies, and real estate sectors.
Right. And you had alluded to something as I was reading, that your fee structure is a little bit different. Is that something, did I understand that correctly?
It depends. I'll mention we have 2 typical fee structures. One of them is very standard preferred return, 7 to 9% annually, plus a split. Anywhere from 70 to 90% of that capital above that goes to investors. 1% acquisition asset management fee. So very much in line with market, maybe even a little bit more attractive than some other competitors out there. We also sometimes will do kind of a straight cash flow profit split where there's no preferred return. We do that oftentimes, Corey, if we're investing in a debt fund that doesn't have any upside. And so, the whole pref plus split doesn't necessarily match the investment type because there is no value add, right? So those are our typical structures and how we create things. At the operating partner level, though, a lot of times we're negotiating more favorable terms from them. And so for aggregating capital and for bringing a larger size check, many times we're able to get sometimes control rights, oftentimes a higher pref, a higher split, lower management fee, what have you. So we're always looking at the economics net to our investors to make sure that they're very fair and attractive.
Right. Well, you got to keep them happy, right? Got to keep the money flowing.
Yeah.
So let's half a step back. SMK What do you look like? 10 people, 20 people, 2 people? What's the firm look like? How are you out there finding opportunity?
Sure. Yeah. So as far as our core team, it's relatively small, by design. I have a portfolio manager that works with me regularly on analysis, updating current investment opportunities, statements, you name it. Accountants, CPAs are a big part of our network as far as in-house bookkeeping, legal, all of that is part of how we handle things.
Right.
Then we also, co-manage with other fund managers that we've got relationships with. And a lot of our, day-to-day operations, Corey, on the property level, the asset management is all on our operating partner's responsibility. Now, what we do is we oversee that throughout the whole life of the investment. So we're on regular asset management calls with the asset managers and the property managers. And so we're constantly, evaluating how they're doing and providing suggestions in areas that we think would be good to implement. And so there's that, managing the manager kind of responsibility that we take on as well.
All right, you didn't, and that's great. So, but I didn't hear you mention underwriting. Who's looking at the new deals, the new opportunities?
Sure.
How's that work?
I spearhead that with my portfolio manager helps as well, but that's a big part of my day to day. I love looking at deals, Corey, and so for me, I enjoy it. It's timely, but it also gives us a great feel on what the market's doing because you're constantly looking at what people are getting this property under contract for, going in cap rates, what kind of debt terms our operating partners are securing, and then being able to do that across different geographies and different real estate sectors on a daily basis. You really have a pretty good inside information as to what's happening out there and what the risks are and where some of the sectors that are providing, outsized benefits are too.
Sure. And look, we've been in somewhat of a interest driven market to the negative, right? The interest rates have been high, slowing people down. How have you found things out there in the credit markets?
Yeah, it's been tough. Obviously, the Fed raised interest rates at the fastest pace in 40 years in 2022, and that put a big shock on the market. I mean, we look at it as, Corey, this is a recession that the commercial real estate market's been through. It's been, I would say, a pretty major market correction, 20 to 30% valuation declines over the last few years. And so, we don't take that lightly. It's an opportune time, in my opinion, to be getting in based on some of the uncertainty out there and the disconnect and the pricing reductions that we've seen. Being able to get in at the basis today, we find very attractive. Again, haven't seen these kind of declines since 08, 09. And so cycle-wise, we think we're probably through the worst, right? We don't know yet.
I think so. I agree. I mean,
You agree? Okay.
I certainly don't, roll dice on, what Jerome Powell is going to do tomorrow kind of thing.
Right.
That's all,
Yep.
I think it's all speculative BS. And I think it's a hard way to live, thinking you're going to wake up and he's going to figure out all your problems.
Exactly.
Right. You got to deal with the hand you're dealt. How have your investors seen it? How have they felt about it? Or they just, they're comfortable with how you run the money?
Well, I think everybody is a bit uncertain, all investors.
Sure.
And some of them are more heightened uncertainty than others. Some people are sitting on cash. They're not doing anything. While others are actively investing, through our guidance. So it just depends on their kind of appetite for knowledge, understanding of the market, what else is going on in their lives, right? It's very individual based. But generally speaking, the deals that we've been investing into, Corey, almost all have positive leverage day one, anywhere from 50 to 200 basis points.
Right.
We are looking for year one cash flow of 3 to 7%. So essentially, if something should happen to the business plan or the market or the economy right after you buy an asset, you'll hopefully be well positioned to continue to ride through that if you're able to see positive cash flow day one. So that's a big part of what we invest in. We're looking for deals that can provide, consistent cash flow throughout the hold of 7 to 12% average. And then there's usually almost always a value add play of sorts that we're going to implement at the asset, grow net operating income, improve performance. For example, in the mobile home park and self-storage space, one of our operating partners recently invested in, they have a team of 8 full-time cold callers, Corey. All they do is call mobile home park and self-storage owners, and they've been doing that for over 10 years. So they have a Rolodex of, it's like 93% of the opportunities that they buy, they're going direct to the seller, and there's no realtor or broker involved, and they're usually buying mismanaged properties where the rents haven't been raised in a decade, and some of them they're managing with a notebook, and they don't even have software. And so that's the kind of stuff we like to see, where you can come in and improve performance and implement, institutional management standards and really grow NOI.
Yeah, I read an article a couple of weeks back about sort of the high-end mobile home business, like booming. It seems to be booming because of, and they alluded to what you just alluded to about maybe mismanagement is unfair, but just old school management, like you say, with the notebook and no software, and no one enhancing things and not understanding the opportunity they have in front of them with respect to the land and things like that. Pickleball courts and all these things that they're developing on the land. It seems extremely opportunistic. Obviously, I don't see all that much. I'm sitting here in the city, so I wouldn't be investing in all that stuff. But I've heard that often.
Yeah, we love those sectors. We've been in mobile home space since 2011 or 12 now, Corey, investing. Oh, wow. Back then, going in cap rate 10%, right. Preferred returns 10%, you hit them year one. That doesn't happen anymore. The space has become a lot more competitive. Yeah. And so, going in cap rates can range anywhere from 5 to 8%, depending on location and quality.
Sure. And that's just real estate. That statement is just real estate, right? But sure. Are you adjusting your hold time based upon the asset class, or you just look at every individual deal in just that way, one at a time?
We always look at the debt term to determine, likelihood of duration of investment, right? They tend to get together. And so most of the financing is, 5 to 10 years, fixed for sure at this rate. We're very much comfortable with fixed rate financing. We're not doing any floating rate at the moment. And so most of our holds are 5 to 10 years. That's the goal. Sometimes there will be a refinance in, years 4, 5, 6, where you can return a majority or all of the principal to investors and then just hold the property in perpetuity. To us, that's a home run, but we're not underwriting to that. So we always tend to have a fixed duration for an investment that we share with investors.
Nice. Do you? I can't help myself, but do you happen to see any retail properties? Do you ever get involved with retail at all? Yeah,
we do. We like, I would say, neighborhood strip retail, Corey. We invested in it numerous times up till COVID. And an interesting story, we had a deal as a 2-property portfolio in Northern California with a repeat operating partner that focuses in that market. We were literally raising capital for the deal in early 2020. Mm-hmm. And, March, whatever it was or so, hit. It was stay-at-home orders, COVID. And we just, we returned our investors' money to them. We said, look, we don't know what's going to happen here. And so we paused, of course, on retail for quite a while. But the last year or two has been very attractive to us. We haven't done much of it since then, but we're all ears. We like that space. Cap rates are very attractive today. You know it very well, of course.
Yeah. Oh, look,
a lot of opportunity there.
Maybe there's something we should talk about offline.
Yes, definitely.
I'm a retail junkie. With 35 years of leasing experience, but also investment experience. Not as long as 35 years, but over the last whole bunch of years. On retail stuff, just invested in something, here in Connecticut, and we got something in Philadelphia. I tell people, when you look at a retail property, you could almost look at it anywhere USA. You send me the map, send me the aerial. I'll know the questions to ask just about the physical before we get into the details of the numbers, right? Like I always tell, someone sends me a property and they send that, like I said, they send that aerial map. The first thing I'm looking at is it at a corner at a light, right? That's to me, as far as I'm concerned, that's the most important starting point. because you need an intersection where you could stop traffic and get people from the other side of the road into your property.
That's right.
And then,
Yep.
and then I start peeling back, right? You look at your neighbors, and depending where we're talking about, you want to know where your nearest Walmart is and your Target and all of your generators. But I just love looking at retail anywhere and everywhere.
Yeah.
Quite frankly,
No, it's a great sector. Definitely been performing quite well lately. So we love it.
Yeah, I mean retail. They're not building anywhere because it's too expensive to build. Retail vacancy across the country is like 4.2%. It's like the lowest it's ever been. And 2 years ago, I think it was like the first time. I don't want to say in forever, but it was the first time in many, many, many years that more stores opened than closed. Because every year there's a flushing out.
Sure.
Of guys that just go out of style, for lack of a better term, or, they go Bed Bath and Beyond and they're just out of business and things like that. When you're out there assessing, underwriting, assessing, whatever, the storage units and things like that, what is it? Just the number you look at again, it's a little bit of a retail tie-in because I can't help myself, but. Location for certain things, for store, how does that, what's the eyeball look like? Educate me.
Yeah. Yeah. I mean, there's, of course, behind the desk analysis, and then there's on the ground analysis. And so they're both very important. We utilize our operating partners to assist in both of those. We, do our own analysis, of course, too, as well, very extensively. And that's why we pass on so many deals, Cory, because if you just look at the deck and, trusted the operating partner
Right.
with everything, then every deal looks great. And that is not
Sure.
the case. And so, as far as like physically, again, we invest in multifamily, we invest in storage, mobile homes.
Mm-hmm.
We also invest in triple net industrial. So each one of those from a physical component can be very different, very different.
Right.
On a mobile home park side, one big thing that we always look for is how many of the homes in the community are owned by the tenants versus us, the park owner, if we invest in it. Are they rentals or are these tenants homeowners? You want to try and find communities where a good portion of the tenants own their own home. It's just much safer from an investment standpoint because you have a lot lower turnover and the tenants are responsible to manage and maintain the repairs, maintenance on their house because they.
And so you're just renting them the land.
You rent them the land, correct? Right. And so operating expenses are much lower than they would be on most other real estate. So that's one thing to look out for. I mean, there's so many more, Cory. I'll give you a few more, and then maybe just jump around for different assets.
Mark, you have to understand. Please hit me with a bunch because, like I said, you're the first person that I'm speaking with. One who's running a fund, but who's also investing differently than most of the people I speak with. Not everybody is retail, but I just haven't been in this category, and that was part of the allure, quite frankly, to speak with you. So please tell me some more.
Yeah. So for the mobile home park space, right? It's the most affordable asset or housing option in the country. They're not making any more of them. Every year the amount of supply is either flat or declining. Some of them are raised and developed into 5-story multifamily buildings, which produces a lot more tax for the county. And so the NIMBYism, not in my backyard, is a deterrent and creates kind of a moat around supply, which we love. You don't see that in most other asset classes. Right. Self-storage, is kind of the opposite from a supply standpoint. You have to be very careful of new supply because it goes up quick. It's cheaper than most other things to build. And the old stuff competes with the new. If you're looking for self-storage, are you worried about how shiny and how clean the paint is or location and price? Really, it's just location and price. And so got to be careful with storage and new supply. So as far as locations go, we're typically looking for more of an urban infill spot for self-storage that has high barriers to new development.
I don't have a ton of experience on self-storage. Quite frankly, just extremely limited. But I remember, this is 10, 12 years ago, someone I was working with had some involvement, self-storage, blah, blah, blah. The only way that they seem, the operator, the self-storage company, could really function. I think it was a name called SureGuard. I don't know why that's striking a chord. I don't know if they're even in business anymore. But it seemed that most of these self-storage companies really can only operate when they own the property. They couldn't make the numbers work on straight rentals. And is it they're that tight? Their operating margins are that tight that they have to own the property?
If I follow the question correctly, I mean, everything we invest in, our operating partners are taking title and owning the whole property, the land, the buildings.
Right,
everything.
but is that they're taking title of the property? It's a self-storage unit, but is that self-storage operator a rent payer? He's a ground lessor. He's a ground lessee. What is he?
Oh, no. What we do, they own the land and the buildings and everything, all the units, and then they rent the units to the tenants.
Oh, so they're buying and they're operating the business too. Yeah,
100%. Yeah.
I guess that plays to it, right? You got to own the land. You got to own everything.
Yes.
Just so the storage business is economically viable.
Yeah, you're renting a 10 by 10 box to people,
Right.
And
Yeah.
so
Yeah.
that's the business of storage. You own the land, you own the buildings, you own everything.
Got
You
it.
pay the property taxes, everything, and so
Understood.
there's a lot of benefits to that, but there's also, again, you got the new supply risk you got to be careful of, and
Right.
so we like these sectors because historically they've done fairly well during varying market cycles, right? You see affordable housing demand tends to go up during downturns. There's a lot of data around that showing NOI growth through 2008 and 9. That's how we got interested in the sector in the first place. Self-storage, similarly, you tend to see, during downturns, recessions, a lot of people are moving, downsizing, moving in with family. That usually creates demand for storage. And so
Right.
you see that historically as well. But we also love apartments, Corey, but not all of them, right? Very particular about where and what, especially the last few years. Apartments have hit pretty hard from devaluations and lower rents and lower occupancy. A lot of that's working through the cycle as we speak, and so we think there's brighter times ahead, but just being really cautious with multifamily and apartments.
Any Section 8 type stuff?
We don't do a lot of Section 8, but we do affordable
Okay.
housing. And so the reason for that is, well, one, you're providing affordable housing to a lot of these areas that need it. And two, you get a property tax exemption for it. And so a lot of the apartments we invest in, we don't have to pay property taxes, which can save hundreds of thousands of dollars a year and provide, strong and steady cash flow to investors, while also, for the tenant's sake, you're providing an apartment that is, probably lower cost per month than some of the others down the street. Now, they still have to work, they still have to qualify, there's all of that, you still have to follow all the rules, but essentially you have a benefit there for not paying the property taxes, which really helps returns for investors. So those are a lot of the apartments that we're investing into these days are tax exempt.
Gotcha. Just a little New York City fun fact. Average one bedroom apartment in Manhattan now is $4,700 a month.
Which is probably like 400 square feet, 500 square feet. Yeah.
Give or take.
Yeah. $1,000 a foot. Right. Exactly.
You can't get an apartment in the city. You can't get an apartment. There's a shortage. There's a lot, without really getting into it because it'll just bore us both to tears, but there's a lot of policy issues that really have screwed up this particular market to the point that in 2019, they changed the rent stabilization laws. Okay, so in one stroke of the pen, people lost 50 to 70% of the value of their properties. By just changing the rules of the road. And besides that, other landlords, because we have some big time landlords with tons of units, what they're doing because of these laws is they're warehousing spaces. Okay, right now, there's approximately 75,000 apartments that are sitting unrented and vacant because the restrictions they put upon these landlords is that they need upgrades from the previous tenant. they put the upgrade in, it's never going to be worth the return because the rent they're allowed to get will be locked in at too low a number for them to get a return. So a lot of these guys, and these are the big boys, they're going to try to wait out the storm. Sure. But this is 19 and we're 6 years into it, and there's all that just sitting being warehoused. It's crazy, you know?
Yeah, for what it's worth, geographically, like, we don't really invest in New York. We're predominantly in the South, Southeast, and the Midwest, sure. A little more favorable for cash flow and rent growth, and tend to stay away from rent control areas. So that's our focus as far as location goes.
No, I think, look, Mark, I think it's great. I think you guys have a great story. You know, you have your company, family, you know, dare I say family business, which I think is wonderful. And I'm hoping one day you call me up and you say, listen, I'm looking at a retail property. Why don't you give me your 2 penny thoughts on it as a retail guy, and then say, hey, Cory, do you want to invest in it? Because I love looking at those opportunities, again, anywhere and everywhere. But certainly if it's Florida, I'd love to get involved, what have you. One day I'll go meet your dad down in Florida. We'll go tour a property together.
Let's do it. I love it.
Yeah. Listen, Mark Khuri, I am grateful for your time. This has been an education. I was looking forward to this, and I hope we stay in touch with each other and do some things down the road.
Yeah, my pleasure, Cory. Happy to stay in touch. Thanks for having me on.
My pleasure. Thanks, Mark.